a race towards the 5 trillion economy in 2030, valuation is no longer a number. It is a superpower. It decides which company grow, which deals happen, and which idea get funded. It is the language of confidence, credibility, and capital. So today, on behalf of Corporate Professional, I welcome all of you for this 244th webinar on business valuation, financial modeling, synergies, deal pricing, and value assessment. And in this, I will discuss also about the voluntary valuation also. Now, in a country where startup scales in month, because every day we are seeing something happening, M&A deals reshape industry. The financial reporting become and sophisticated over the year, and continuously it is growing. Understanding valuation is not a skill, it is a survival strategy now. Today, we all decode how value is created, how assumption drive the future, and how synergy can turn an ordinary deal into a transformational one. So the number, how the valuation can help, and that can show you a different transformation one. So please be ready because valuation is not just analysis. It is something which is changing the entire structure. And today we have to dive into this. Today in our topics, we will discuss understanding when and why valuation are undertaken, overview of valuation approach and methodology, regulatory and financial reporting valuation requirement, valuation in transaction, M&A, fundraising, ESOP and others, fundamental of financial modeling and valuation, practical insight and common FAQs in valuation practice. These are the issues we will discuss today. And now I will, because we have invited the speakers from industry, professional, those who are doing day and night the valuation work, the merchant banker, and the professional who is doing multi-valuation. So first I will welcome our panelist, Mr. Aryan Chopra. And Aryan Chopra is Associate Vice President of 197. That's called popularly known as Paytm. He leads group level finance controllership, audit and reporting functions, and has extensive experience in handling complex transactions, including merger and acquisition, fundraising, restructuring, ESOP implementation, and related party transaction governance. He has the key finance team lead one of the India's largest IPOs. He has over 14 years of experience, including more than 7 years in Paytm across progressive leadership, role as a general manager, deputy general manager, assistant general manager, and senior manager prior to Paytm. He worked for nearly 8 years for SR Watley and Associate. So he has a practical experience of multiple companies, and now he is in the 197. And he has served in SR Watley, a major telecom and e-commerce client, including Bharti Airtel, Indus Tower, and Dyson, and various others. So with this, let's bring in someone who live valuation, breathe numbers, and sees the fintech world from the inside. Our first speaker. I welcome Aryan for this program. You are coming first time, so you're double welcome because you're continuously supporting this way will help all of us. Then I welcome Mr. Chirag Kothari. He is a partner, Nagpur office at Corporate Professional. With over 8 years of experience, he has developed a strong expertise in domain of valuation, assurance, and business advisory service. Having worked extensively with listed entities and multinational client across diverse industry, he began his career as an executive in assurance department at EY, where he gained valuable exposure to complex audit and financial reporting numbers and financial various environment relating to this. So Chirag, welcome for this program. Then we have Sanchit Vijay, partner and head deals and valuation, corporate professional. Sanchit Vijay is a chartered accountant and the CPA. and he is doing various other course also. He has an experience of more than 500 to 800 valuation, which he has done for listed, unlisted, ESOP, uh, and various multiple types of valuation he has done. I welcome Sanchit for this program. Then we have Ava Shukla, Manager Valuation Corporate Profession. She is also play not only with Excel, but inside the Excel, she jump and she see what is happening in this. So with all these people's expertise and knowledge, we will discuss these various topics. Friends, as I inform in advance, because our knowledge sharing is continuing and it will continue. So our next webinar on 12th December, that is on Competition Act, key issues, challenges, and the way forward. That is, we will discuss. Now, before I give it to my learned speaker, I just want to share my views on the valuation, and simultaneously, because the picture is very big. Valuation is no longer number; it's a national capability. And when national capabilities issue comes, then the question comes that are we waiting for any event? Are we waiting any regulatory requirement? Or third option is, or we should do something voluntarily. So I will discuss about the voluntary valuation also along with other points. So friends, valuation today is not just a technical skill. It has become a national capability, which I have told you, shaping how capital moves, how business grow, and how investor trust over market. Globally, economies and master valuation, the US, UK, Singapore attract disappropriate capital not because of their structure, but there is a the valuation gap. They give higher valuation because they understand better. So India is now entering into this league because valuation is a strategic tool, not a compliance tool or compliance numbers. Most companies do valuation when they force, but globally leading companies perform annual voluntary valuation because it gives them a clear picture of enterprise value, early warning signal, strategic clarity for decision making, stronger board discussion, and better capital allocation. Compliance valuation tell us what value is today, but voluntary valuation tells us how to create value tomorrow. So this is the basic difference, and these things we will discuss and we will do this. Now, India's shift for decisiveness from compliance valuation to strategic valuation, because in India, if you see the entire ecosystem of the valuation process, the majority valuation, majority valuer, they are focusing on compliance valuation. But the valuation is not compliance, it is a strategic valuation, because compliance valuation is just a formula driven and you are giving your signature, that's all. But the main things come with the strategic valuation. For many years, valuation in India is seen as a compliance requirement that you require for FEMA, you require for ESOP, you require for SEBI, you require for M&A. But in last one decade, especially post 2020, transactions have become more sophisticated because more complicated. Regulatory expectations have become sharper because they want to check everything. They are not accepting only formula. They are saying you must see behind the formula. Reporting standard have become deeper, and the capital market have become more demanding now because you cannot just give numbers or give valuation just like this. So your discounting or your valuation enhancement both have to be logically concluded. Today, valuation is a strategic boardroom function because all companies they discuss because promoter need a mirror, objective, data driven, unbiased. So this is one. And when I was saying voluntary valuation, because it's provide a independent lens to truth, business health, cash flow strength, marginal stability, and competitive position that is also there. Now, the valuation landscape has become multidimensional. That is also another aspect. So in India, earlier when we were saying this valuation we require for FEMA, this valuation we require for SEBI. Now, if you are going for M&A negotiation, you require valuation. If you are raising fundraising rounds, you require valuation at every round. ESOP pricing, that is also required, because when you are giving ESOP. Purchase price allocation, you have to do this. Impairment testing, you have to do. Related party approvals, that is also require valuation. Fairness opinion for M&A by SEBI, it is also required. AIF VCP deal committees, they want valuation. They want to see whether the company is giving the shares at the right price or not high or not low. Independent directors decision making is also required. DRHP disclosure for IPO, that is also required. So you can see the valuation landscape has changed totally. Now it is not only compliance, it is the multinational. So earlier 5 people cared about valuation. Today every serious decision maker is talking about, because that time 95% they were just seeing what is your number, how, and what is the number related to compliance. So because investor and lender trust companies and they track value also. Also, the company that regularly reviews valuation send a signal of transparency, because it is not that one time you have taken a valuation and then you are silent. So what is happening continuously, you are not aware. So just see, if you do regular review, the valuation of that company give a positive and better signal to all, in transparency wise, maturity wise, professional governance wise, discipline wise, and long term planning also. So everybody can understand this company is doing something progressively. So, and these are the things creating a investor confidence for better lending and other things. Now the question is, why financial modeling is now the heart of valuation? Because today's topic is not only valuation, it's the financial modeling also. So all valuation model ultimately collapse into one simple truth, that is assumption drive value. So model qualities determine valuation quality. A good model tells you what creates value, what destroy value, what leaves management must pull, and what market is really pricing. So all these things comes under the financial modeling. In global market, modeling competency is considered equal to financial literacy, and India is something also moving into that direction. And then government ecosystem is also working for that. Friends, today business family need valuation to plan succession. That is also one of the important. Voluntary valuation is essential for family settlement, division of business, share transfer, intergovernment planning, unlocking value for next generation leadership. So it prevents dispute and enable smooth transaction. So that is another aspects of valuation and financial modeling. And you should not wait for the family will divide. You have to work out today how the valuation will do, and all disputes settled when valuation is perfect. So today's word, from classical valuation to data-driven valuation, is another aspects, because AI is coming. So now in last 2 years, AI tools, cloud-based modeling, and predictive analysis are transforming the way valuation are done. Globally, we now see AI-assisted forecasting, automated comparable analysis, scenario engineering, predictive discount rate modeling, and real-time market adjusted variation, and the sectoral risk heat maps. So in next 3 to 5 years, 60 to 70% of early stage modeling will be AI assisted, and leaving expert to focus on judgment, adjustment, and interpretation. Because today, if you are focusing on Excel and making data and number that anybody can do, that is a change which is AI will bring. Now, because board need valuation to take informed decisions, sometimes what is happening, the board requires continuously and valuation, continuously information, and that day is not far when this will be a compulsory agenda part of the every board meeting. So under SEBI and Companies Act expectation, board must ensure fairness, reasonableness, transparency, and predictability. So voluntary valuation, if you do, and if you do business modeling and the financial modeling, then you can do the scenario analysis, you can do value impact analysis, you can make independent judgment, and you can clear decision framework. And this is the position where they strengthen board governance. And friends, the India's advantages, our market are evolving faster than any other economy in the world. India is 5 trillion economy, which will go 10 trillion in 2035. And we'll see massive activities in M&A consolidation. We'll see a startup exit. We'll see AIF scale up. We see SME to mainboard transition. We see family business succession, asset monetization, which is taking but not very aggressively, infrastructure SPV, private credit markets. So valuation will be at center of all these things which will take place. As you see, ESOP, fundraising, M&A opportunity come without warning. So if you think that when the opportunity will come, I will make, then you will lose the opportunity. So you should be ready with this. When opportunity come, only when valuation ready company can move faster and they can immediately grab this opportunity. So a pre-prepared voluntary valuation help company respond quickly to investors queries, present value logical to banker, fast decision making for buyout, and evaluate acquisition target and justify ESOP pricing. Readiness save time and lost opportunity. So you require valuation or not, but if you are keeping this and doing this, it will can make a huge difference of your thinking. So today, when we see synergy or deal pricing, the most misunderstood but most important area is there. We often say synergy creates value, but synergy is also the biggest reason deal fails. Measurement, modeling, and stress testing is synergy is now critical discipline. Global research says 70% M&A fails because of the achieving synergy target, the way they have planned. Value leakage typically happen in first 180 days. Over optimism in forecasting is biggest culprit. Today we will discuss how the model synergize realistically, because an annual valuation builds discipline. Just like annual audit and annual valuation brings financial discipline, forces investment management to review assumption, highlights risk earlier, track value movement over years, build an internal culture and data-driven thinking, and it become powerful internal KPI that whenever the valuation going down, you are setting aside, you are working out. My message to young professionals, those who are there, is in any valuation, Excel contribute 30% and judgment contributes 70%. So you don't focus on 70%. You should focus on 70%, not the Excel. Your understanding of the business, governance, management quality, competitive advantage, and market structure matter far more than formula. If you understand this concept of the business, the numbers will start speaking to you. And because business planning without valuation is incomplete, so future strategy will be pricing, expansion, capex, hiring must align with the value. So all these things, if you want to do it, then you have to just work out that how you can do this and you prepare yourself. So the future strategy, capital efficiency, optimal gearing, margin improvement, market positioning, all things can become a strategic tool in your hand. Now my message to promoter and the investor also, because sometimes they ask Boon, an investor wants something at a throwaway price. Today, the valuation number is not important. The story behind the number is very, very important. It is everything. Investors are looking for value creation pathway. What is value today is not important. The value of future is important, that how much growth is there. And the number is speaking about this or not. Profitability, visibility is there. Scalability is there. The sustainability of margin is there or not, and predictability of cash flow, that is also there. So a strong valuation story builds confidence, and confidence attracts capital. That is the fundamental principle. And because valuation gap can destroy a decade of efforts, because sometimes your valuation is say X and you are Xing X plus plus, then people will not do, and time will come that you may destroy your value also. When companies don't take value, they fail to see margin compression, customer concentration is working capital inefficiency, governance gap, sector disruption, competitor outperformance. So we should prepare and we should work out that how the valuation financial modeling can work and how the voluntary valuation can highlight these things. And that's why I told in future every boardroom, every board meeting will have the one chapter on valuation, that how much value has created of the company, where is the leak, where is the final thing, because number is okay. So you can show PAT, you can show your turnover, but if you are showing valuation, the valuation tells so many things together, that how much gap is there. Global market reward valuation maturity, that is also there. US, UK, Singapore, top companies do value voluntary valuation because market reward predictability, investor reward transparency, and board rewards insight. Employees reward clarity and acquirer reward preparedness. So India is moving in the same direction, and companies that adopt the early uh, become future ready. That can be done. So your valuation should be perfect, not high, not low, and it should talk about the logical numbers, and that is the future scenario. So friends, these are my initial comments on this valuation, and I have always suggest people that you must try to do and do the valuation continuously. Don't wait for any opportunity. Opportunity will come when, what will you do? So that is one part. So the program structure will be like this. Now Sanchit Vijay will speak on understanding when and why valuation are undertaken, an overview of valuation approach. Then Arihant will talk about the practical aspects. Abha will talk about the methodology of valuation, and Chirag will discuss about the fundamental of financial modeling and valuation. And then Sanchit will close it with this valuation in transaction, M&A, fundraising, ESOP, and more. And then we will have question answer. So I will request now Sanchit Vijay to take this session forward and discuss about the very understanding of when and why these valuation.
Thank you so much, sir. I'll just present my screen, the presentation. Just hold on a second. Yeah, I believe the screen is visible and you can all hear me talk.
Yes.
Great. Uh, so, good evening, everyone, and welcome to this deep dive session on valuation. Before we begin, I'd like to probably warm up a little, and I would want to ask you guys and see to it that when you hear the word valuation, what is the first thing that comes to your mind? You can type it in the chat or just write down the question, or you can just write personally to me as well. It could be DCF, right? Price, investors, fundraise, ESOP, negotiation, anything. So, absolutely. All of these are correct things that comes to your mind when you hear the word valuation. So today my goal is to take all of these fragmented ideas that you have had and consolidate them into a complete understanding. Um, um, for now, before we begin, let me quickly walk you through what we'll be covering today. In the next slide, please. Just to give you a clear roadmap of the session, we'll start with the basics, what valuation really is, what is not. This will help in a clear common misconception right at the very beginning. Then we'll move into the history and evolution of valuation in India and understand how it becomes such an important and modern part of financial decision making. We'll understand why valuation is required, from compliance and reporting to fundraise, ESOP, and M&A. We'll deep dive into the three core valuation approaches and the methodologies followed under them. We'll do a detailed breakdown of what discounted cash flow method is and how valuations are actually built from. We'll be touching upon the foundations of financial modeling because a valuation is only as good as the model behind it is. Then we'll go into the more interesting parts, the myths, the misconceptions, the major red flags that the auditors, investors, and the regulators immediately notice. And towards the end, we'll be talking about the future of valuation, how the next decade will change what and how we value from talking about influencers to AI driven generative AI valuations, all of that. And finally, we'll close with certain FAQs, key takeaways that we feel that you may have. And obviously, in the end, we'll do a Q&A round. And with all my esteemed dignitaries who have joined the webinar, they'll be giving their own bits and pieces of the contents that I've just shared. So the session is designed to be very interactive. So feel free to share your thoughts, ask questions, drop a comment as we go along, and let's make this a conversation and not like a monologue that I'll be giving. Uh, so let's start with the first thing. What exactly is valuation? Uh, Next slide. So we'll be talking about valuation is the analytical process of estimating the economic worth of a company. Next slide, please. Yeah. So valuation is the analytical process of estimating the economic worth of a company, asset, or a security. Now that sounds very textbook. So let's break it down a bit. Valuation is essentially a blend of, I would say, financial analysis, forward-looking modeling, understanding of the market environment, and a significant amount of professional judgment. It answers one fundamental question: what is this worth and why? It could be a business, it could be a brand, an investment, or even a liability. As businesses evolve, valuation evolves with them. And valuation is never done in isolation. It must follow certain standards and principles. In India, valuers follow the ICAI valuation standards as well as the international valuation standards and certain specific regulatory frameworks such as the Companies Act, SEBI, FEMA. Um, Valuation is also guided by the premise of value, whether the business is assumed to continue or be liquidated or valued for use versus exchange. These are the premises that keep on changing and it changes the outcome entirely for a valuation. So, one thing becomes clear early on: valuation is not a formula, it's a framework. So, this is exactly what valuation means. Next slide, please. We'll be now talking about what is not a valuation. So before we go deeper, let's clear a few misconceptions because valuation is often misunderstood. Valuation is not a fixed number; it's an estimate. It's always an estimate. Valuation is not a guaranteed selling price. Negotiation and sentiment matters. Valuation is not just a book value. Valuation is just is not just revenue multiplied by something. Valuation is also not static. It changes with assumptions, it changes with business conditions, it changes with the environment, it changes with the market, and it changes every day. So a backward looking exercise, I would say, it's very future oriented. So let me give you an example. If two valuers are given the same business, the same data, and asked to estimate value, there is a high chance that they will both arrive at two different numbers. Why? Because valuations involves a lot of judgment. There'll be different assumptions in both the valuers that will be valuing. There'll be different lenses of risk that the valuers perceive in the respective environment, different interpretations of how the business will be performing in the future. So if you've wondered why do valuations vary, that's why. So that is why we say valuation is a science and an art. Now we'll look at what exactly is the evolution of valuation in India. Uh, I think 20 years ago, valuation was not at all what it is today. It was more informal, often arbitrary, and not governed by a consistent framework. But with the advent of time, things have changed. With the growth of complex businesses, fundraising, regulatory oversight, valuation could no longer remain a casual exercise. I think the key turning point in India for valuation should be when Companies Act 2013 introduced mandatory valuations for many corporate actions. I think IBC 2016 made valuation indispensable for insolvency and restructuring. Then came the ICAI valuation standards that introduced discipline and uniformity. And finally, SEBI and the RBI framework expanded the scope of valuation in FDI, fundraising, ODI, and preferential. Suddenly, whether it's a startup raising funds or a company issuing ESOPs, a merger happening, a buyback, a slum sale, valuation became central. So, valuation in India evolved from an opinion to a structured analysis to a regulated professional discipline. And this evolution is still happening. And India is now aligning more and more with global valuation practice. Uh, Now let's look at why valuation is required. Now the question is, why do we need valuation at all? Think about any business decision where valuation matters. I'll give you a few examples. Uh, I think when a startup is raising fund, a company is issuing ESOPs, a promoter is buying out its shares, a M&A happening, a company allotting shares to a foreign investor, tax authorities questioning fair value, bankers assessing any security, financial reporting like PPA happening, purchase price allocation, or impairment, or any fair value is taking place. Insolvency is happening or a restructuring is happening. If there's any investment decision making, each of these cases that I told you requires a reliable estimate of value. Let me ask you, I think, how many of you think valuation is primarily needed only for fundraising? Because in reality, fundraising is only one part. Compliance based valuation today forms a large chunk. Valuation required for FEMA, valuation required for income tax, Companies Act, SEBI, or INDES. So valuation is not optional anymore. It is embedded in virtually every major corporate and financial decision. So let's coming to the main part, the approaches to valuation. Um, I'd like to ask you, all valuation work globally revolves around three primary approaches. Uh, the first is income approach, which talks about the future cash flows discounted to present value. Then we'll talk about the market approach, value based on how similar companies are priced. Then the asset approach, where value based on the fair value of underlying asset minus liabilities taken into account. These are not the methods, these are approaches. The methods under them, under these approaches, are different. It could be DCF, it could be trading multiples, it could be NAV, or whatever the valuers may apply. We'll explore all of these approaches, all of these methodologies in detail. So by the end of the session, you will know exactly when and why each approach is used. So now let's start with the first approach called as the income approach. The income approach is the most powerful and the most analytical of all the three approaches. It answers one question: how much will this business earn in the future as on today? This approach focuses a lot on the future performance. And I think the most popular and the most known method under this approach is discounted cash flow, which a lot of you guys may know by the name as DCF approach. So let's break it down simply. Estimate revenue for the upcoming years, estimate the cost, estimate the margin, estimate the taxes, adjust for all the capital expenditure and working capital, arrive at a forecasted free cash flow, choose the right discount rate based on the risk of the business, calculate a terminal value, and discount all cash flows back to the present. I know it may be very overwhelming when I say all of this, but we'll come to the detailed part. But the DCF approach captures the growth potential, the risk, the operational efficiency, the capital structure, the sustainability of business. It is This approach is, I think, perfect for any company with a stable and predictable business, SaaS or subscription based model, or mature businesses with consistent margins, or probably whenever we are doing a ESOP compliance or Indias. But DCF approach is very sensitive, I may tell you. It is very sensitive to the assumptions that we take into account in the future performance for any company. You change the discount rate by 1% and the valuation changed dramatically. And DCF is realistic if done honestly, and very unrealistic only when assumptions are inflated. So I think we covered about what exactly income approach is. There are other methodologies as well, and we talked about DCF. We'll be going a lot more into detail about DCF in the coming slides. So now let's look at and let's move towards the next approach called as the market approach. This approach answers that what is the market paying for a similar company today. It uses very real data. It uses very real transactions and real trading multiples. I think the two main methodologies within market approach are comparable companies and comparable transactions. We look at multiples like enterprise value to EBITDA or enterprise value to sales, the PE ratio, industry specific KPIs. We look at that. I think the strength of this approach is that it is very simple. It's very market driven. It reflects the investor sentiment very deeply, and it is great for fundraising and strategic investors. I think there are certain limitations also. It is difficult to find the perfect comparable within the market. Finding the similar company, the market volatility affects the output. The underlying differences must be adjusted, but overall, the approach keeps valuations grounded in reality. So, this is what the market approach is all about. Let's look at the third approach and the final asset approach, also called as the cost approach. This is the most fundamental approach that is there out of the three. It answers that what is the company's assets worth. Obviously, we adjust assets and liabilities to the fair value. And it is really relevant for companies that are loss making, companies with volatile cash flows, non operating assets, distressed companies, real estate driven companies, and cases when there is a liquidation scenario. Um, the strengths for this approach would be that it is very conservative, it is clear, it is auditable. But I think the most important point that it lacks on is the failure to capture the earning potential. It doesn't value the intangible or the scalability of any business. This approach usually gives a floor value, the minimum economic worth. So I think this was all about the approaches and methodology. I'd like to now pass on the baton to Mr. Aryan Chopra, uh, and he would be talking a lot more about the practical insights on the fintech space. Over to Pawan sir. You can
Okay,
give
thank
the
you, Sanchit. Thank you, Sanchit, for giving this detail. As I told you in the beginning, uh, Arhant is someone who lives valuation, breathe numbers, and see the fintech world from the inside. So our uh, next speaker, who's from the industry, because all other people are giving how the valuation can do, but why the valuation is required, and what management perceive the valuation, what the board see this, and when valuation report is coming, what question board is asking, what are the other parameter, and Arihant is handling with the regulator also. So what regulator is thinking. So overall view, Arihant can tell us. Over to you, Arihant.
Good evening, everyone. Thank you, Pawan sir, and thank you, Sanchit, for this opportunity. Uh, my introduction, Pawan sir has already given to all of you. So I have been part of Paytm family since 2018. Before that, I spent almost 7 years with EY. So yes, between Paytm and EY, I have had a long relationship with spreadsheets, financial statements, valuations, and obviously the auditors and their audit queries. Obviously, regulators are also there, but I don't want to name them. Uh,
Okay.
so the topic today is, which we are discussing on this forum, is valuation. So it seems uh, I can say it's a very crucial topic for all new startups or the companies which are in mid stage and planning for IPO or thinking of IPO, or the new generation, Gen Z generations. So this valuation in itself is a wide framework which encompasses a lot of things. What we can see that every business ultimately run its operations to create value for its customer, for its shareholders, and for its people. The day-to-day activities, decisions, and investments all tie back to one fundamental purpose, which is building something that is worth more tomorrow than what it is today. So value creation is the ultimate objective. I can say value creation is one of the most crucial and ultimate objective of doing any business. And now, as Sanchit has uh, briefed you all about in very detail that what approaches, how these this work, I will not go into detail technicalities around this, but I will touch base the practical aspects around valuations and how when you get a valuation report from your valuer, then how board sees it, what questions board asks, what questions auditor asks, and in future if it opens for scrutiny by income tax department or by your AD bank or by FEMA authorities, then what questions they ask. So first of all, I would like to talk about how valuation landscape has changed over the years. So business today, as we all know, are far more complex, especially with the rise of tech and digital models, where the traditional metrics do not always tell the full story. We all are aware about market volatility, shifting interest rate, global uncertainty, the wars, uh, the uh, the the US impact, and the regulatory uncertainty. One of the very quiet and latest example of regular uncertainty is the ban on RMG apps. RMG is real money gaming apps. So when we were talking about in this webinar about risk uncertainties, then this is one of the uncertainty. Suddenly the government has banned their business and challenged the business model. Suddenly the companies which were valuing like billions of dollars, their valuation goes down to nothing because their business model in itself has been challenged and was banned. So all these things are very critical while doing a valuation assessment. Further, the age companies have assets which are more of an intangible nature. When I say intangible in nature, it means they are not visible. We cannot feel them. So what these assets are? These are like customer data, technology, which read those data, analyze those data, and get some information out of those data, and create some products based on that information, and reach out to those people who can buy or use that products or services. So uh, and most of the time, because of the accounting standards requirement, people don't able to capitalize all these things in their balance sheet. We all are aware about that because these are largely off balance sheet items. So once these are not in the balance sheet, then it also becomes very critical how you value them. And how, first is how you value them, and second thing is how all the intangibles have been appropriately captured in the valuation reports. So this is a few aspect. In addition to this, like all decisions, and why valuation is important. So my previous statement is like what complexities has come in valuation. Now I want to elaborate why valuation is important. So every decision roams around the valuation thing. Should we acquire a business? Should we expand? How do we allocate capital around various segments? So all these are dependent on one thing, that how it will create value for the stakeholders. Valuation has both short-term and long-term impact. on the balance sheet and P&L. If a valuation is not properly done, then probably it will hit your P&L very badly. And obviously, once it impact your P&L, then it will also impact your net worth, because you all know about impairments and all. So if you have bought something overvalued, then probably in 2 or 3 quarters or in a year's time, when you reassess the value of that asset or that company, then probably your auditor will ask you to record the impairment. So it is very pertinent that we should have a right valuation report in hand. From my limited but intense experience, one thing is clear to me, and Pawan sir has also told about that valuation is not just about the numbers. It is beyond numbers. It is to understand the business, to understand the potential, and to understand the risk with the business model. Now, coming back to some practical aspects around the valuation thing. Like when you are in a company and you use valuation for your day-to-day operations or your acquisitions and anything, and you need the valuations, right? Because this is required from both governance point of view and from compliance point of view. Plus, valuation, nevertheless, valuation is also required to decide the commercials, right? So commercials, I'm barring commercials aside because this is the topmost requirement to have valuation. But apart from the commercial negotiations, commercial discussions, you also need valuations from your governance point of view and the compliance point of view. Compliance point of view is like from income tax point of view, it is required. And if it is in a FDI transaction or ODI transaction, then from FEMA point of view, it is required to be in your records. Now, many times in my past experience, I have seen that people take valuation report. They do have valuation report, but the sanity check around the valuation report is missing. When I say sanity check, then it means that you have valuation report in place, but you don't have, or you don't have that in a proper shape or manner in which it should have been. Like, like in the previous slides, which Sanchit is presenting, we were discussing about the valuation methods, DCF, NAV, market multiples, and many others. So one of the valuation report, we have applied one of the method, but the rationale and justification why those method have been selected is not documented properly. Then it will go for a toss. So it is of utmost priority that we should document the rationale and justification for having a right valuation method in the and it in and the justification should be documented in the report itself, and it should be reviewed by the company, and valuer, obviously valuer will review this, but company should also read and assess this and check this that it suits with the situation in hand. So and my dear friends, having right method is the first key to have a right valuation report, because this is the base. If your base is wrong, then the entire valuation is not correct. It's like playing a badminton with a cricket bat. It might work briefly, but it won't end well. And the right approach for valuation method depends on many factors, like maturity of the organization, how mature the organization is. Is it a 2 3 years old company, or it is in the system from last 6 7 10 years? Availability of market data or comparables, any recent transactions done which is done by the company, and any intangibles like brand, technology, customer relationship, which are often not in the balance sheet. So these are some of the critical points which should be looked into or reviewed before selection of an appropriate method of valuation. Once you select the method of valuation, then the next topic is, or the real game begins. And the game is around lot of assumptions. Assumptions in the form of discount rate, revenue growth rate, EBITDA margins, capex estimate, working capital requirement. So all are forecast. You don't know what will happen next year, but you project it for 5 years. So if you are projecting something for 5 years, then it should be done with utmost care. It should be backed up by solid evidences so that you can justify your work which is done today after 5 years time, that why you have done or why you have selected a number at that particular point in time. So you should have a very valid, documented, evidenced numbers which you are using in your valuation report. And as you all know, a slight change in discount rate will drastically move or down your valuation. So it is very important to have these critically documented in the valuation report. Sorry, my bad. I'm not. I have a bad throat, so sorry for it.
No problem.
Uh, so this is around the world of assumptions, and and one more thing which I would like to focus on, that valuation. I have already told that valuation is beyond numbers. Valuation is an art. So you get some number by doing a valuation. So obviously number tells the story, but what makes sense? It is the judgment, that whether the number arrived by this valuation makes sense or not. It is purely dependent on the judgment of the valuer and the judgment of the company. That based on these assumptions, I am getting this value. Is it making sense, or it is not making any sense? So we should also do assumptions around that. Sorry, we should also do a sensitivity around the valuation. So sensitivity, what does it mean? Like if you get a value of, let's say, 100 crores based on some inputs, and if you change certain parameters and the numbers are getting up and down, like 90 crores or 110 crores, then you should do a proper justification to yourself that how these numbers are making sense. So arriving a sense out of a valuation report is of more is of a top priority, because once you have sense, then only you will be able to explain these reports in front of anyone. If the numbers are not making any sense, then probably we will not be able to explain these reports. And the third and last thing which I would like to explain is that uh, if we do all things very well, but we don't document these very well in our reports, then probably we are not helping ourselves. The reason why I am telling so, because valuation report is not a just one time activity. Like if we are doing a M&A transaction, we get a valuation report, we just document it, present to board, get it approved and close. No, it will not end here. After a quarter, if you're a listed company, then after a quarter, auditor will come. If you're unlisted, then at annual audit, your auditor will come. They will check. Then you think now it's okay, we are done. It's done. No, it's not done yet. When your income tax assessment will open after 2, 3, 4 years, then probably tax department will ask for these valuation reports. And if it is a FEMA transaction like FDI or ODI transactions, probably your AD bank or RBI will ask for these valuation reports. And if at that point in time the valuation report is not properly documented, then probably we will be in trouble. in that point in time. Why I'm saying so? Because it is thanks to the attrition which is there in the organizations. Like most of the time, we have seen that people who worked upon the valuations 3, 4 years back are not there in the organization when the report open for the scrutiny. So, a well documented, well articulated report will save the company and the people who sign off it. So, it is our top priority that we should have a report which should be very well documented and articulated with all rational and justifications for all the assumptions and all the backups. So this is around the valuation thing, which which I have to which I wanted to tell you all. And before I conclude, I truly want to acknowledge the incredible effort being put in by corporate professional team in doing these webinars regularly. This is 244th webinar. This is in itself an achievement for them, and I truly admire the dedication, consistency, and commitment to professional learning. I am glad to have been one of the best beneficiaries of this initiative. Thank you once again for having me today. I wish all the participants an insightful and enriching session ahead. Thank you.
Thank you very much, Aryan, giving the real insight of the valuation aspects from the other side of the table.
Thank you,
All
sir.
our professionals here, we talk about how to do valuation, but we are not talking about the how the valuation will be perceived by the other side. So the sanctity check point you have mentioned is very, very valid, and every professional company or every valuer should understand this part, that whenever we are making numbers, the sanctity check will also be there. And the most important thing which you have told, that today the compliance is not the valuation. The valuation is something greater than this. Though I was planning to ask you question, that question on session, but I'm not stopping me. Just tell me, are you doing valuation when you require, or this is a continuous process you are following? Because in your company, opportunities are coming continuously. You're doing tie-up, you are joint venture, investor is coming in, putting a stake in company. Sometime you are doing a restructuring, sometime you are bringing out new product. So what is your strategy in your organization, or the other organization which you have worked? What you're doing only when it is required, or you are keeping ready?
So, sir, my point of view is that valuation is not a one-time activity. It is a regular activity. So the frequency depends, like you do it monthly or quarterly, but it is a regular activity. And now I am part of a listed entity, so I don't bother much because we are already listed and our valuation is there. But whatever I have seen from an unlisted entity point of view, or the valuation where it is not very clear and not visible in the market, then probably those entities, and especially the startups, they frequently do their valuations, probably every 6 monthly, without waiting for any M&A or any fundraising to happen. They frequently does this. It will help them. So, and my point of view is that it should be done on some regular basis. Why so? Because it will help them to understand where the valuation is actually going. So if they do at the time of any activity, then probably then there will be no time they can correct it. But if they do it frequently, then probably they will have some time to see and to correct if they found any issues or any anomalies around it.
Okay. Okay. Thank you, Aryan. Now we'll ask questions in the question answer session. Now, friends, uh, now we have to hear uh, the handle valuation at a scale where every Excel get nervous. So next speaker is who will talk about the methodology of valuation. Okay, and so Abha, you are speaking first, or Chirag? Chirag, you are fundamental of valuation modeling.
Yes, sir. The
Yeah.
next session is for Chirag, sir.
Okay. So Chirag, so when I told you the way you people are do valuation where Excel get nervous. So you have to tell how you are making Excel nervous and bringing out the best from the result from this. Over to you, Chirag, for telling fundamental of financial modeling in valuation.
Thank you so much, sir. Thank you so much for this opportunity. And it feels great that sessions like this, enhances the knowledge, and we can, share our views on these various topics. I would like to discuss on fundamentals of financial modeling in valuation. I'll just share my screen. I hope it's visible.
Yes, it is visible.
Yeah, thank you. So here we will discuss some of the areas where which are necessary for financial modeling. Uh, when I talk about financial modeling, it has to have a purpose. So what is financial modeling and what does it involves, right? So basically, it includes building a structured representation of company's financial performance that can be used to estimate the intrinsic value of the particular company.
Anu, bulana हमको.
So here, what we are going to discuss is we will understand the core components of financial modeling. What exactly what we do after we have we perform the financial modeling. What are the analysis that we do? What is the process that a valuer does once the financial modeling or the financial statements, once we use them, how do we execute this to arrive to a specific value? So, as I mentioned, purpose of financial modeling, the uses of financial models is to estimate a company's value. So it can be equity value or enterprise value. It supports investment decisions, whether to buy, whether to sell, or whether to hold. Evaluates merger and acquisitions, assess fundraising, capital structure, and strategic planning. Some of the core components of financial modeling are historic financial analysis. So, we take last 3 or 5 years of financial data. We understand the how the financial statements have been, what are the results for the past 3 or 5 years. So what we do is we take a three statement model. So basically, one is income statement, second is balance sheet statement, and the third one is cash flow statement. These three statements are the core for any financial modeling. So what we do is from income statements, the inputs that we understand from the past data are revenue, margins, or profitability. From the balance sheet, the inputs are assets, the capital structure, or the liabilities. The cash flow statements help us to understand what are the operational cash flows, what are the investing cash flows that are done in the company, and what are the capex, if I term it into capex, the financing flows consisting in the company. So this historical financial data helps us to understand how the company has been structured and how it has been functioning throughout, and it helps us to prepare a base for future data to be projected. What can be the projections down the 5 years or 10 years down the line, right? So second, once we understand the historical financial data, then we have to understand what are the operational drivers which we can forecast that helps us to project data for 5 years or 10 years down the line. So one of the operational drivers can be revenue growth, price into volume assumptions. It can be gross and operational margins, capex of the company. Uh, Apart from that, there can be working capital ratios, which can be accounts receivable, accounts payable, inventory days, tax rates, and what are the financing assumptions that the company has been doing. Once we know the operational drivers, then we move on to preparing to build the three statement model for a projections. The three statement model that I mentioned, the income statement, the balance sheet, and the cash flow statements, these are projected accordingly, which later help us to derive a free cash flow calculation. Free cash flows can be free cash flows to equity, free cash flows to firm. The working obviously changes accordingly. So what are the components of financial statements? As I mentioned, a balance sheet, P&L, profit and loss, income statement that we mentioned, and cash flow statement. These are the three model statements that are the core for any financial modeling. Balance sheet includes assets, liabilities, equity. Income statement includes revenue, expenses, net income. And cash flow statement obviously includes operating activities, investing activities, and financial activities. So what we do once we understand once we have the projections ready, how do we analyze this particular data that has been prepared for a projected basis? Once we have the three statement model done, ready for 5 years projections are ready, how do we use this particular data to analyze and generate a specific value to it? How do we generate, how do we arrive to a specific value? So financial statement analysis is one of the core thing before before jumping into any valuation conclusion. It can be simply divided into 8-step process. So if I divide this 8-step process, so step 1 and 2 is basically a setup stage where we focus on defining scope and gathering necessary data. The step 3 and 4 are organization and standardization. These are about making raw data useful and comparable. Step 6 and 7 is analysis. This is the core analytical phase. Here, we understand key performance indicators, which are ratios. We also analyze movement over time, wherein we check trends and underlying characteristics, which are patterns. These are all calculated, spotted, and deeply analyzed. The last one is the conclusion. This is the final step. It is used to analyze information to actually determine the final value. So basically, once we are done with all the analysis part, now we can derive or calculate the final value once this all steps are done. So for any financial analysis, there has the key inputs that we get are through internal sources and external sources. So internal sources are obviously within the organization itself. These are annual report, profit and loss, balance sheet, cash flow statement, statement of change in equity, notes and disclosures. Correct. Then comes to the external source of financial analysis. So these are details of traded companies, market transactions, industrial studies, publications, etc., newspaper reports, technical information of process structures, etc. So with this external sources, what we focus is on the capital structure of the company, working capital cycles, how the industry operates, how the company, whether is it in line with the whether the working capital cycle is in line with the industry standards. Then we check the market share of the company and its position, credit ratings, business and reporting environments, operational scale efficiency, life cycle of companies. So while we do financial analysis, three important analysis are done. So one of the analysis is ratio analysis. So once we get the projected financial statements, we prepare a common size statement wherein we also use various ratios to check the in performance of the company. Various ratios help us to determine various how the company is performing, whether it can be liquidity ratios, profitability ratios. Liquidity ratios specifically can include the current ratio, quick ratio. We can also, we need to check what is the gross margin, net margin through profitability ratios. Then is the trend analysis. So while we prepare cash common size statements, we prepare this common size statement through two different analysis. One is the horizontal analysis, then is the vertical analysis. So horizontal analysis is done two ways. It can be, so one horizontal analysis is comparing the data, the three level statements that I mentioned year on year. So we check what are the trends, company's growth or the company's performance year on year. Also, horizontal analysis has to have is to be checked via external sources. So the company's performance vis-a-vis the market scenario. What is the industry standards? What are the benchmarks in the industry? How are the comparable companies performing in the same industry? Then comes the vertical analysis. This is also very, very important. Vertical analysis is comparing a single line item, financial line item, with the base value. So we can check what certain amount of expenses is, what percentage of expenses is to the total revenue, what contribution does the particular expenses does do to the total revenue in the while we prepare the common size statements. Next is the comparative analysis. So here we analyze various industry comparisons. We check the company comparable companies, and we also do benchmarking. So apart from this, overall analysis has to have a broader perspective. It has to have a sensitivity analysis and the scenario analysis. So sensitive analysis is has to be, again, it depends on a professional judgment. It has to be taken utmost care of. Along with that, the valuer should also have a scenario analysis wherein different scenarios, what the company value, what is the value of the company in various scenario. It can be best case scenario, worst case scenario, or the base case scenario. So this is how the financial modeling works in order to derive to a particular value of the company. Thank you so much. This was all with my presentation. I will pass on to Pawan sir for the next.
Thank you, Chirag. Thank you giving the fundamentals of financial valuation and how to do valuation. Now, these fundamental points are also very, very important to do this. We can talk about anything relating to the finer point, high-end talk, but ultimately we have to start the base. Ground level work has to be something very strong. Now, friends, our next speaker who will talk about the valuation methodology, and because she is working deep into the numbers, identifying that which methodology will be followed and why, and then sanctity check that is done by Abha. So now I'll request Abha to present her presentation on methodology of valuation. Over to you, Abha.
Thank you, sir. That was a insightful session by Mr. Chirag on the financial statement analysis. Good evening, everyone. I am glad to continue the discussion and share my perspective on selecting the right valuation approach, understanding how a DCF valuation is actually performed, and the foundation that supports it all, financial modeling. After all, a DCF is only as reliable as the model behind it. So maybe this section will feel slightly technical, but I'll try to keep it conversational and intuitive. And by the end, you will be able to connect the dots clearly. So let's just share my screen.
Yeah, it is
Hope
visible.
it's
Prabha,
visible
go
to
ahead.
you all. Okay. Um, okay. Basically, a question is, how do we as a valuer actually select the right valuation approach? In reality, the selection depends on basically four practical filters that every valuer uses consciously, or you can say subconsciously. First is purpose of valuation, why the business is being valued, and directly shapes the choice of approach. Uh, Whether the objective is fundraising, regulatory compliance, transaction pricing, financial reporting, or restructuring, what's the purpose behind the valuation? The same company can have different valuation depending on the context. If we can do the valuation for income tax purposes on the for the transfer of shares is basically defined the formula in income tax itself. So we have to apply that method. And if we follow the preferential allotment for a listed entity, then Regulation 164 prescribed the formula to arrive at a transaction value for frequently traded shares. So ultimately, the purpose of valuation will decide what approach and what method we can select for the valuation. A clear understanding of the purpose ensures that the valuation is relevant and aligned with the expectation. And the data availability, what the second aspect is data availability. What information do we actually have? If we have reliable forecast, detailed financials, and the clarity on the capital expenditure, working capital requirement, then definitely DCF becomes meaningful and appropriate in that scenario. If we have good market comparable listed entities, comparables, and recent transactions data is available for that company, then definitely we can select the market approach, and market approach is appropriate in that case. If operating data is weak, but that company holds a lot in that assets, and identify assets can hold the great value, then definitely NAV becomes appropriate in that scenario. The valuation approach is only as strong as the data behind it. Third point is business life cycle, business stage, and also its cash flow stability. If the company's business is stable, so mature businesses with predictable margins, definitely DCF works beautifully in that case. And if the company is high growth or early stage businesses with the fluctuating cash flows, in that case, market approach is more realistic. Uh, for example, in loss-making or distressed companies where future profits are uncertain, asset approach becomes the safest method. And the fourth point is the fourth parameter is industry and market conditions. In high growth sectors like software companies, tech companies, and D2C businesses, investors really rely heavily on market multiples. In regulated industries or asset heavy sectors like manufacturing, real estate, infrastructure, often NAV or DCF plays a stronger role. In conclusion, each case will explain how valuation professionally actually decide which approach to use, because as we all know, valuation is not one size fits all. The purpose of valuation is basically relies on the maturity of the business and the nature of cash flows all influence the method we select. We can we can discuss the 3 case studies. How do valuers select the valuation approach in different scenarios? In our first case study, consider a mid-sized, profitable, unlisted company. The business has been growing steadily. The EBITDA is positive. The customer renewal rates are predictable. And we have more than 5 years of reliable financial history. The company now wants to issue ESOPs to senior employees. So what's the purpose of valuation here? The purpose is not to value the business or the business for any transaction. It is purely for accounting for fair value of stock options as required under Ind AS 102. This is the valuation required for financial reporting purposes. And ESOP valuation focuses on the option value, which depends on the underlying equity share value. Here, we first determine the fair value of the equity shares of the company. And since it's an unlisted entity with no observable market price, we need a proper business valuation to compute the equity value. Given the stable revenue streams and predictable cash flows, the income approach, specifically the DCF method, becomes the logical choice. So for this case, the approach is in 2 parts. First, we have to determine the underlying price through the equity value derived from the business valuation of the company. And the second part is once we have done the equity value, we apply the option pricing model like Black-Scholes or the binomial model to arrive at the fair value of the ESOPs. In conclusion, the approach aligns here is as per Ind AS 102 requirements. Let's move to our second case study. A high growth startup which requires valuation for fundraising. So here we consider a D2C brand that is scaling aggressively, growing almost 3x year on year. The brand has strong traction. Customers love the product and revenue is increasing rapidly. However, profitability is still low because the company is reinvesting heavily in marketing, customer acquisition, and brand building. This is exactly how most early stage and growth stage startups operate, prioritizing scale over short-term profits. So the purpose of valuation here is fundraising, essentially determining how much equity the founders will dilute and what valuation incoming investors will agree on. So how do we think about approach selection in this situation? First, investor in high growth startups care for more about the future potential than the current or historical profitability. Second, the cash flow over the next few years are unstable and highly volatile. So it's making a DCF model extremely assumptions heavy. Third, the sector has been multiple early stage deal recently, which means we have strong market data on how similar companies were valued. And finally, the brand has strong visibility in the market, and investor sentiment is often reflected much better in market multiples than in a long-term DCF projection. So in this case, the market approach becomes the appropriate method. We rely on comparable company multiples such as revenue multiples, GMV multiples, or sometimes gross margin multiples. Why? Because the best benchmark for fundraising it was what investors have actually paid for comparable companies in the same sector. A DCF may still be prepared, but for purely for the cross-check purposes, not as the primary method. In conclusion, during fundraising, investors almost always benchmark a startup against comparable deals. So the market approach, particularly revenue or GMV multiples, tend to look appropriate. Let's move into our third case, a company where the problem is not growth, but survival. So here in our third case study, consider a manufacturing company that has been making losses for the last 3 years. The reasons are external as well as internal. Rising raw material cost, outdated machinery, and operational inefficiencies. As a result, the cash flows are highly volatile and unpredictable. But despite the losses, the company still has something valuable: material assets such as plant, machinery, inventory, and working capital. The purpose of valuation is, in such situation, is usually linked to restructuring, potential sale, or even insolvency proceedings. In all these scenarios, the emphasis is not on growth potential but on the recoverable value of the business. Now let's think through the approach selection. Since future cash flows cannot be projected with any confidence, the DCF method is simply not appropriate. Company is loss making and the business model is unstable. So comparable multiples also do not work because they would not reflect the distressed condition accurately. However, the company's tangible assets can be identified, valued, and measured separately. So for this case, the suitable valuation method is the asset approach, specifically the adjusted net asset value method. So when the business has more asset value than the operational value, the cost approach is appropriate to this kind of valuation. This approach allows us to restate the assets to their fair values, especially plant, machinery, land, and working capital, and derive the equity value based on realizable assets rather than expected profits. In conclusion, when a business is loss making, volatile, and has no visibility of turnaround, the asset approach becomes the most logical and accepted valuation method. So with these cases, we have seen how valuation approach selection depends entirely on the company's stage, purpose, and cash flow visibility. Let's shift to the next part of today's session, how exactly a DCF valuation is performed. So let me begin with a quick question for everyone here. If you were buying a business today, what would you really be paying for? Basically, not for the past, not for the even the present. You are actually paying for what the business will earn or will earn for you in the future. And this is exactly what DCF captures. DCF simply means a business is worth the present value of all the cash flows it will generate going forward, brought back to today using a discounting rate that reflects risk and time. This is one of the most widely used, but also the most misunderstood valuation methods. So let me break it down in the simplest, most practical way. Before we run a DCF, we need three building blocks. Think of them as ingredients in a recipe. So first is future cash flows. These come from a structured financial model, which includes revenues, cost, operating margins, capital expenditures, and working capital. Second is reinvestment needs. Growth always requires investment. So the financial model must capture the future capital expenditures plans and working capital requirements of the company's business. Third is forecast period. So DCF typically uses a 5 to 7 year forecast period, the years where growth can be reasonably predicted. So in DCF, we mostly use two types of cash flows approach. One is free cash flow to firm, that is also called FCFF approach, where when valuing the business as a whole, we compute free cash flow to firm, where the company or the business sourcing the funds from the debt as well as the equity shareholders in equity form. This is the cash generated for both equity and debt holders before any loan repayments or interest work servicing. It's completely derived from the financial model, ensuring valuation is aligned with business reality. And the second approach is free cash flow to equity. If we want to value only the equity, we could follow the approach of FCFE, that is free cash flow to equity, which is cash available after accounting for debt repayments or debt movements. This is used when the final output required is equity value directly. And the second input is in DCF is the most important, discount rate. So two type of discount rate we can use. First is cost of equity and second is weighted average cost of capital, commonly called as WACC. The next step is selecting the current discount rate. So for example, we are using the FCFF approach, then definitely we have to use WACC in our calculations, which blends cost of equity and cost of debt based on the company's capital structure. So, and if we use FCFE, FCFE cash flows in our DCF calculation, then we have to use cost of equity derived through the cost of capital model, commonly use a capital set pricing model, that is CAPM. The golden rule is here that the cash flow type and discount rate must match. If we have to use FCFE, we use the cost of capital in our DCF calculation, and if we use FCFF, we use WACC for discounting those cash flows. And the second, the last point is terminal value. After the explicit forecast, the business still continues. And if we follow the going concern concept, we assume and we believe that the business will run till infinity. So in that case, and the future is the future is captured through terminal value. Two common methods are here to calculate the terminal value. First is perpetuity growth method. This assumes stable long-term growth. Or second is exit multiple method. It can be used when in market EV by EBITDA or EV by revenue to estimate value at the end of the forecast period. Terminal value is typically the biggest component of a DCF. So it must be tied logically to industry maturity, long-term inflation, and sustainable growth. So DCF formula arrived around 60 to 70% of value through its terminal. Last component is present value and final valuation outcome. Once cash flows and terminal values are estimated, we discount each of them back to today using the appropriate discount rate. The sum of all discounted cash flow gives us enterprise value if we using FCFF and the equity value if we uses FCFE. Then we make final adjustments for subtracting debt, add cash, include non-operating assets, and finally compute equity value per share. And this is the most important point. A DCF is only as good as the financial model behind it. A structure model that reflects revenue derives, cost structure, CapEx strategy, and working capital cycle ensures that cash flows are credible. And we always perform scenario analysis and sensitivity checks because DCF is assumption driven and we must test the robustness of value. So we have understood how our DCF valuation is performed from cash flows to discount rates and terminal value. The next logical step is to discuss the backbone behind all of this. This is the financial modeling. Our DCF is only as good as the underlying model. So let's look at how financial modeling supports a robust valuation exercise. Before that, we can check this DCF template. Here we can present a DCF of ABC Private Limited. The weighted average cost of capital is 34.44%. Growth rate is 5%. So here we opted for free cash flow to firm approach, started from PAT, add back the depreciation, that is not non-cash expenditure, less all the capital expenditure, less change in working capital, and then we have discounted it through mid-year discounting. which arrives at enterprise value. And then we have to adjusted the cash and cash equivalent as on the date of valuation, investment and security deposits, which lies in the balance sheet of the company as on the date of valuation, and less the total debt, which lies in the balance sheet of the company as on the date of valuation. After adjusting all these items, we come to equity value of the company, and divided by the diluted number of shares as on the date of valuation, we can arrive at equity value per share of the company as on the date of valuation. So this slide will brief you about the financial modeling, key modules, model outputs, and analysis techniques of the financial modeling and valuation. Financial modeling is essentially the analytical engine behind valuation. It converts business understanding into structured numbers, projections, and scenarios. A strong financial model helps us forecast revenues, cost, capital expenditure, and working capital, build the three statement model, that is PL, balance sheet, and cash flow, compute the FCFF and FCFE for the DCF valuation, identify value drivers, and test the robustness of assumptions under different scenarios. In short, without a well-built model, the valuation cannot be accurate or defensible. So what are the key components of a financial model? A robust financial model is not just an Excel file, it's a structured framework. Let me quickly walk you through the key components. First is revenue model, where the money comes from. Here we break down the company here we break down how the company earns revenue. This captures pricing, demand, market size, customer segments, and growth logic. This ensures that revenue projections are logical, data-backed, and tied to business reality. Second component is cost structure. This model captures all cost elements, fixed, variable, overheads, manpower, and unit level economics. It helps us understand margins, operating leverage, and how cost behave as the business scales. The third component is working capital. We model receivable days, payable days, inventory levels, and cash conversion cycles. This shows how much working capital the business needs to sustain growth and whether the operating cycle is efficient. The fourth component is CapEx and asset schedule. This part of the model includes both maintenance and expansion CapEx, assets, useful lives, and depreciation. It ensures the valuation reflects reinvestment needs and assets replacement cycles. Fifth component is debt schedule and interest cost. We lay out all existing and projected borrowings, repayment schedules, and interest cost. This allows us to compute net borrowings and ensures FCFE is accurately calculated. And the last component is free cash flow computation. Finally, all modules feed into the FCFE or FCFE computation. These cash flows drive the DCF valuation and reflect the business's true economic capacity to generate value. And the analysis techniques is scenario analysis and sensitivity analysis. One of the most important purpose of a financial model is to help management, and that brings us to scenario and sensitivity analysis. So basically, scenario analysis is that we create multiple versions of the future, base case scenario, optimistic case, downside case, and then average out it to arrive at a fair value of the company. And for the sensitivity testing, this works differently. We change one variable at a time. For example, discounting rate, growth rate, capex, or working capital days. Then we analyze the impact on valuation using sensitivity tables. Sensitivity testings highlights the key value drivers and expose model vulnerabilities. So to summarize, financial modeling is what converts business understanding into numbers. It ensures that every assumption is traceable, comparable, and testable, and it gives decision makers clarity on risk, upside potential, and value drivers. I hope this gave you a clearer perspective on how valuation professionals combine business insights, financial analysis, and structured modeling to arrive at credible valuation outcomes. Thank you for your attention. I will now hand over the session to Mr. Sanchit Vijay, who will take you through the next segment of today's webinar. Thank you so much.
Yeah, slide is not visible. Sanjay, you have to unmute.
Yeah. Abha, please present the screen. So I think it was a very insightful session by Arihant, Chirag, and Abha, explaining from the practical insights to the components of financial analysis, the assessment behind it, and then to the session on the financial modeling and the DCF approach. I think we are towards the end, and I'll be talking a lot about what are the myths and red flags when it comes to valuation. Before we go further, I want to address this that we'll be breaking down the biggest myth one by one and replace them with the correct understanding. So the first myth is that valuation is an exact science. People feel that people assume valuation should give exact number accurate to the last decimal. But think about it. We are estimating the future. No one can predict the future's revenue, margin, market dynamics, or risk with absolute precision. So valuation is not a precise number. It's a range supported by logic, assumptions, and methodology. That's why even regulators accept ranges and the auditors look for reasonableness and not perfection. Myth 2. Multiple multiplied by revenue is equal to the valuation. This is one of the most dangerous shortcuts that a revenue multiple or a EBITDA multiple cannot be blindly applied because every business has different risk. Growth profiles differs, the customer dependencies differ, the margin differs, the working capital cycle differs, the capital intensity differs. So no, valuation is not just a plug-in revenue into a formula. It requires analysis, adjustments, and qualitative understanding. Third, uh, valuation is equal to price. Valuation is what a business is worth. Price is what someone is willing to pay. The two can be very different. Think about the distressed sales. The price is lower than the fair value. Or think of strategic acquisition. A buyer may pay a premium far beyond valuation because they see synergies. So while valuation is a financial estimate, price is an outcome of negotiation, power, timing, urgency, and emotion. Myth 4. Uh, Probably valuation is only for fundraising. Valuation in reality, majority of the valuation in India today happens for compliance, FEMA, income tax, ESOP, financial reporting, mergers and restructuring, all of that. Myth 5. Um, all valuers should give the same value. This is like expecting all doctors to prescribe the same treatment for the same symptom. It doesn't work that way. Valuation involves judgment. Different values may take slightly different assumptions, risk perspectives, or even companies that have different comparable. And that's perfectly normal. The key is that reasoning must be strong, rational should be there, consistent, and defensible. Myths create unrealistic expectation and leads to distrust in the valuation process. Once these myths are removed, stakeholders begin to appreciate the complexity and the rigor behind valuation. Now let's talk something that is extremely important, the valuation red flag. These are warning signs that something in the valuation may be flawed or misleading. The unrealistic forecast. If a forecast shows very high revenue growth, steadily increasing margins, no competitive pressure, and zero volatility, that's a huge red flag. Businesses do not grow in a straight line. Future projections must reflect reality and not optimism. Second, discount rate not matching the risk. A discount rate must reflect the business actual risk. If the company is early stage, high risk, or dependent on a few customers, it should be high risk. But the discount rate is low, the valuation becomes inflated. So we should take care of that. Terminal value abuse. Usually, terminal value often makes up to 60 to 80% of DCF value. And if terminal value is based on high growth or unrealistic multiples, it distorts the entire valuation. Wrong or irrelevant comparables. Using companies that are not truly comparable leads to misleading marketing valuations. For example, comparing a global SaaS company to a small domestic software firm, not the correct approach. Ignoring the working capital and the capex need um, is a red flag. This artificially inflates valuation. Blindly using book values in the asset approach, or probably not doing sensitivity analysis. If a valuation does not show how value changes with assumption, it's a problem. So next slide, please. These are the common red flags. It does not mean the valuation is wrong. They indicate that the assumption required deeper scrutiny, and identifying these early improves the reliability and credibility of the valuation. We'll be now looking at the next decade, the future of valuation. How the future valuation is going to be completely different from what we see today. The next decade is going to be bringing revolution. It will be revolutionizing the way businesses and even individuals are valued. So let's explore where valuation is headed. Uh, Next slide, please. Yeah. So first is the rise of intangible heavy valuation. Traditional valuation was driven by tangible assets, but today the world's biggest company derive the value from brand, software, algorithms, data, distribution networks, user bases, communities. Valuation will increasingly focus on intangible drivers. Second, the AI driven valuation models. AI will transform the valuation landscape by analyzing massive data sets in seconds, identifying hidden patterns, predicting revenue trajectories, benchmarking risks, and improving the forecast accuracy. Valuers who embrace AI will have a very big major advantage. Third, the influencers and the creator economy. This is a big one. Influencers, educators, content creators, each one is a micro business with predictable revenue streams, communities, brand partnerships, and repeat engagements. Valuation models will evolve for creators just like the startup valuation evolved 15 years ago. Fourth is the valuation of algorithms and AI model. AI model themselves will be valued as a standalone economic asset. Valuation of digital communities and memberships. Communities today have retention, engagement, monetizing potential, and strong network. The sustainability and ethical premiums, the ESG, compliance, carbon neutrality, ethical supply chain, social impact will command higher valuation multiples. Rather, investors are shifting to long term value creation over short term profits. Last but not the least, the human capital and the skill cluster valuation. In knowledge driven businesses, the talent pool is the business. And valuations will start quantifying the special skill set, the innovation teams, leadership capital, and talent retention risk as well. So, valuation is moving beyond spreadsheets into AI, digital ecosystem, and intangible economies. The next decade will redefine what value truly means. And I think I'll be taking into account the closing remarks from my end. Today we covered the entire valuation landscape, what valuation is, how it evolved, how it's performed, its challenges, and where it is headed. Uh, Let me leave you with three powerful thoughts. Valuation is not just about numbers; it's about understanding businesses. Second, valuation is not about predicting the future; it's about assessing the risk of the future. Third, the future of valuation will belong to professionals who combine financial expertise with technological understanding. So we'll be opening it up for questions. These are some of the FAQs that we have finalized. We have jotted down, but we are open to the queries, questions that you may have. Um, you can go through our FAQ section if you have any questions around them.
Okay. Thank you, Sanchit. Thank you for giving insight of future also. And that is the need, because now future AI modeling and everything has to change. So what will not change your judgmental value. So those who are more focusing on number and the compliance valuation, they will be outdated. So everybody should realize that they have to do something bigger than this, what is happening. And the most important thing, if you do this, then the quality of valuation, quality of modeling, and quality of actual valuation will take a new shape. Now, I have few questions with you, all of you. I just want to cover it like this. Aryan, this is one first question I want to ask you.
Yes.
How has the definition of value changed in last 5 to 7 years in India and globally? Because just now Sanchit has also mentioned, Chirag and everybody has mentioned, and I also mentioned, you also mentioned. So the valuation, which was a number, it has converted to the value. So what are the changes is taking place in last 5, 7 years?
Uh, in last a decade, I can say the definition of value changed very dramatically, both in India and globally. It's not that only India is impacted, it's a global change. Earlier, valuation was primarily driven by financial metrics, revenue, EBITDA, net profits, but gone other days. Now, value is increasingly linked to elements that don't always sit on the balance sheet or not, they are not visible, like customer engagement, brand strength, how important your brand is it a very known brand or not brand not known, the technology capabilities you have, is it scalable or not. Scalability is very important thing in the valuation. If your business model is not scalable, then probably you will not fetch much value, because what now what is the word, the term is value has shifted from what the company earns today to what the company can become tomorrow. And hence the scalability of the business model is very important. If it is scalable, and one more thing which I would like to add from my practical experience is that the cross sell opportunity, like you are building and developing one product, but how it is or how it can be linked or mapped to other products or services which can be cross sold through that product. Like if you are in a payment business, then what are the cross sell opportunities? Will you be able to provide lending facilities to those merchants, or will be able to provide more value added services to those merchants in terms of assisting them in bookkeeping, in their record attention, helping them understanding the market, helping them grow. So these all are the factors which are not there in balance sheet. It is embedded in the business model, which decides the value of that enterprise or that segment. So that is my thought process around it.
Perfectly all right. Sanchit, you want to add something on this change in value? Any other thing which you have not spoken?
I think what Aryan just said, it is absolutely correct. Earlier, the value was judged mostly by profits, assets, past performance. But in the last 5 to 7 years, it has expanded to a lot to include the future strength and the competitive advantage that people have. Aryan mentioned the customer value, the brand value, the technological part. And I think in simple words, earlier it was what you earned, and today it is how strong is your ability to earn sustainably in the future.
Okay, okay. Chirag?
Think very well added by Aryan. Uh, so value has the meaning of the definition of value has changed a lot, and nowadays investors are also interested in the story behind the company, as sir has also pointed out earlier in the discussion. So the company's growth perspective is very, very important down the line. It's not only about the numbers, the current scenario the company is in, but also the growth prospects that the company is going to generate. The
Okay.
market is it's very, very important.
Okay. So how the arrival terminal value for thermal power plant? Sanchit Chirag, can you tell?
So, hello.
Yeah.
So again, to arrive at a terminal value, see, terminal value is nothing but what a company has value post the 5 years in their financial modeling. And any client, any company, any industry, I would rather say I would like to articulate it in a manner to arrive. You don't use a generic perpetuity growth DCF the way you might feel that for normal operating capacity, because a thermal plant is an asset with life, PPAs, regulatory constraints, and sometimes have decommissioning costs. So the clear practical approach would be to first identify how long the plant will continue, when the plant stops, what are the economic values around it, what is the finite life for that plant. Usually it is 25 to 40 years. What all things you will be covering in the end, whether it's the capex, the overhaul, the residual and salvage value. Um, these are the methods on which we can finalize the terminal value. But again, it's absolutely very technical, because it's a very specific thing when it comes to an industry.
Okay. Chirag, in the bridge EV to equity value, it is mentioned to add investment. I have seen investment reduce from post money to arrive at a pre money value. Can you give clarification?
So, when we when we derive to equity value from enterprise value, we add the investment. The reason being, when we arrive to equity value, the investments we considered non-operational investment belong to the shareholders. So that non-operational investments are to be added when we derive to equity value. And in now the venture being when we go through a venture capital method. So to the investments are reduced from post money is because that is the additional amount being infused in the company. So therefore these are two different scenarios, and the value is calculated in two different ways. Therefore the two ways to look investment into this.
Okay. Aryan, board and independent director increasingly rely on valuation opinion. What
Yes.
additional disclosure should be mandated when board is asking what they want to see?
You have rightly captured a very valid point, that because what happens practically, uh, that the company decides a deal. Company means the management decides a deal. They agree on the commercials based on certain judgments, certain estimates, based on some value assessment. Then we also document this, or we also corroborate this with the valuation which we do. And then comes the board, for because board is the ultimate authority who approves this transaction, or who gives go ahead to this transaction. And if you are a listed company, or a large private or public limited company with independent directors, then they will ask questions from you, like, because ultimately they will be held responsible, they are okaying it. So as a board and independent directors heavily rely on these valuation reports. So broadly, in my experience, what I have seen, that generally they are asking that that who the valuer is, like what is the credential reputation of the valuer is. So if it is a reputed valuer, then uh, probably the comfort level of board is different, whereas as compared to a fresh or newly appointed valuer. So first thing is this, and the second thing is that do we rely on one valuer, or have we considered more than one valuer to assign or identify the value? And if we have identified more than two values, then are they and what is the outcome? Is it in sync or is it really different? So these are some of the questions. Then the other questions being asked by the directors are regarding the assumptions which we have used, like sensitivity around those assumptions, how sensitive the valuation is. So these are some of the critical things being asked by them, and obviously the independence of the valuations, how independent the valuer is, who is doing this valuation.
Okay.
Plus, one more thing which I would like to add is that the report should be a speaking report, because nowadays, if you are a listed company, then probably the requirements around disclosure and sharing of your reports are a lot. Like you send the reports along with your agenda items to your board of directors. So the report should be self-explanatory. So once a director opens that report and read it, then he can clearly make out some sense of that report, that why the value is justified. So a clearly documented, articulated report is really helpful. And as a closing note to this query, I would like to add that board should not be told not just what the value is, but how sensitive and how reliable that value is.
Okay.
So these are the parameters.
Sanchit, important aspect of ICI standard that should be considered while undertaking business valuation exercise.
I think from the ICA standard, engagement basics are very important before you even start the valuation. The purpose, identifying the subject, the valuation date, the scope and limitation, the independence and conflict check. The second would be to finalize the basis of value plus the premise of value, a correct valuation, but clearly state what are explained explicitly the basis and premise. Also, for a quality of valuation report, there should be specific qualitative characteristics that are should be there, like understandability, relevance, reliability. In simple words, valuation is not just a number; it's a defendable explanation. Proper information, assumptions, and management inputs, which are a big scrutiny area, should be properly drafted and defensible in all manner. And again, it should be a speaking report. All the valuation approaches and method selection and why you chose them and why you did not choose them should be covered in the valuation report, and it should ensure consistency and cross checking. Adjustments that most people miss out, but they should be clearly answered on in the valuation report. And again, finally, the documentation, reporting, and the compliance statement. We should always ensure that if you are following the ICA valuation standard, the report should clearly state that it is prepared in accordance with them. And super simple speaker line we should also present whenever we are giving the valuation report.
Okay.
So these are the
Ava,
things that we should keep in mind.
okay. In your experience, what is the single biggest mistake companies make while estimating value?
So most of the time, the financial model is not prepared in accurate manner. For example, we have identified some mistakes, some routine mistakes, if a startup has value considered the interest in their financial statement, but balance sheet present no debt in their capital structure. So these kind of mistake, the three financial statements are not aligned within it, and some organizations don't provide the cash flow itself, which is major critical basically document to arrive at cash for the balance sheet.
Okay. Uh,
Yes.
are Indian valuation becoming more aligned with global standard, or do we see gaps? Arvind, what do you feel? What are the need changes are required?
So normally from my practical experience around it, uh, most of the reports which I have seen are almost aligned to the global standards. Because the FEMA itself says that, because if we know about the FEMA rules, the pricing guidelines, they said that any internationally accepted valuation standard should be applied. So the DCFs or the multiple approaches, these are aligned with the international valuation standards. So in my practical use case, I have not come across any valuation report in which there is a deviation from the international valuation methods.
Okay. Sanchit, how do you see AI and predictive analysis reshape valuation practice in next 5 years?
I think AI will not replace values, but it will make valuations faster, automated models and quick benchmarking. It will make it more data backed with better comparables, market signals, and trend deduction, even more scenario driven, probably weighted outcomes. But it will not replace values. I think that will be a very important reshaping of valuation in the next 5 years. I think AI can scan hundreds of companies to identify better comparables as compared to a human, where we have to first research, find the right business, and find then the comparable. I think it can flag abnormal assumptions like margins too aggressive versus the industry a lot more better. It can also help us in simulating scenarios like rate hikes, demand slowdown, pricing change. But the final judgment, like what to trust, what to adjust, what's realistic, what assumptions are right there, should be there, will still require human expertise, and I think that cannot be replaced. So it will definitely make the valuations more accurate and data backed.
Okay. Uh, how do you value a company in innovation or innovation stage, Chirag?
So, company, at the invention stage or innovation stage is basically we can use various probability management scenarios. We can also, do we can use market approach. So there will be different approaches that we can use, because it is a start. It is a start. It is at a startup stage. So we can use scorecard approach, and we can use two various multiple approach methods to derive to a specific value uh, for the company.
Okay. Now, last few questions, which is very, very important. Aba, regulatory and how do you balance the difference between valuation expectation for regulatory valuation, transaction valuation, financial report valuation?
Sir, basically each serves a different purpose. Regulatory valuations are rule based, transaction valuations are market driven, and financial reporting is compliance focused. So I align the methods with the objective but keep assumptions consistent. The key is reconciling differences clearly so stakeholders understands why values differs. Basically, we provide a reconciliation on the basis of those methods.
Okay, this question has come in the valuation. Listen carefully, Sanchit, Chirag, and Abha. In the valuation, long-term debt was deducted from EV to arrive at equity value. This amount
Okay.
is usually the debt in the balance sheet on valuation date. What will be the treatment if the LT debt, long-term debt, increases in projected years? Will we take same amount on valuation date or some other value?
Sir, basically, to arrive at equity value, we have to deduct the debt as on the valuation date, and the movement of debt is captured on the free cash flow to firm or free cash flow to equity, whichever approach is opted by the valuer. The movement of the debt on the projected years is already captured in the free cash flow calculations. So existing debt is deducted to arrive at equity value, which is lying on the balance sheet as on the date of valuation.
Okay, okay. So my last question, how the AI, though Sanjit has given answer, but now this is one question we have talked about. The valuation is now the value, and the value comes by not numbers by multiple parameters. Now, what you see the future of valuation, number one, in a vanilla way, and number two, in the AI era. I'll start with Chirag with you. This is the last question which I'm asking.
I'll take this question from a financial modeling perspective when we talk about AI. So, you were already talking about Excel, working in Excel. So definitely, working in Excel will be, reduced, will decline as modeling construction tool, but it will be dominant when we talk about, modeling container and audit environment. uh, what I feel is AI builds the model, but Excel proves it. It explains it. We can sign it off and get it approved. So this is, it will go hand in hand, but definitely the working of Excel will decline as the AI will replace it.
Okay, Sanchit.
So I think the new era of valuation is shifting from static spreadsheets only to the data rich, scenario heavy, standard driven work, because more value now sits in intangible, as we discussed, and risks are moving very fast. Rates are changing, regulations are changing, climate disruption, a lot of things are happening. So valuation is becoming more data plus input centric and not just financial statements. A lot of qualitative aspects are being associated with valuation. Earlier, we relied heavily on audited financials or a management projection deck. But now, values are expected to use richer input sets, customer cohorts, churn rates, retention, usage metrics, funnel conversion, unit economics, pricing data, and platform indicators. AI becomes a valuation co-pilot, which will help in faster, broader, but must be governed as well. It will help in screening large sets of companies at one go. Scenario generation, probability weighting, all of that will the AI will be helping us in making a more accurate evaluation.
Okay, Abba.
So, sir, basically AI we can use in valuation as such, because financial modeling and Excel, VBA, all the tools are already in market to prepare the financial model, which is dynamic in nature, and will update according the changes in the scenarios or sensitivities.
Okay, Arent, your last comments on this.
Sorry, sir, I was on some another call.
No, I was just asking that we have talked about the valuation is not valuation, it has value. And
Mhm.
second is the value is not determined on with number, with multiple factors. Now AI is also coming. So how you see the valuation future and how you see the valuation segment in next uh, generation.
Okay. So it's good that you have touched upon this AI thing, artificial intelligence. AI is the uh, next boom. What I can say. Uh, if AI is there, because AI is impacting every aspect and every arena of the things which we do currently, either in our professional life, personal life, or anywhere. So how come valuation remain untouched by the impact of AI? From companies' point of view, because companies like us or companies who are very technology dependent are also doing a lot on AI stuffs like automations, robotics, and all these stuffs are going on. Like how you can automate your accounting, how you can automate your workflows, how you can automate or how you can use AI to build some more use cases, some more products which help your customer and it makes their life easy. So, from that point of view, it impacts the business. Now, from valuation point of view, so if you are going to deploy AI in your business models and effectively, and it's not just your copying paste, doing copy paste from other, like everyone is running in the race of AI, and you are also running in this race of AI without applying your mind, then will be no use. But if you are doing and applying effectively the AI in your daily or in your business, then probably your value will go multifolds. So that's the impact of AI on the business models. And obviously, from a valuer point of view, because right now what I have seen from my practical experience, that a lot of time, as Sanjit also mentioned, that a lot of manual intervention is involved. Like you are doing search, you are doing some sensitivity. Once AI is there, it can help you in doing all these stuffs, and you just need to apply the human skill, which is your judgment. So judgment will be yours, and you can use your apply or you apply your judgment in the AI driven or AI driven results. So that's how I think that it's a proper combination of human intelligence, which is their subjectivity and judgment, and the AI driven output. It's a combination of them. And if you have both of them, then you are the superstar of that point in time.
Parent, if I summarize your point, you are everybody having a clay, and then you have to just move it and make it whatever things you want. Everybody has a stone. How good sculpture you are making, that is depends upon you. So how much you can ask. So I think these are the point. Two comments I have received. Excellent presentation by panelists. Please share copies of our presentation that I will send Mala sir for everybody. And thanks for questions, Mr. Jayesh Joshi has mentioned. So now, friends, it's a time we are overshooting the time. So as we conclude today's session, one thing become absolutely clear. Valuation is not a spreadsheet activities. It's not number only. It is a leadership responsibility. It shapes strategy, strength governance, guide investors, and prepare business for the future long before the future arrives. So you are just thinking a visionary activity today for future. In a fast growing India, where ideas scales overnight, deals move quickly, and market evolve every week, those who understand value will lead, and those who ignore it will be forced to follow. So आपको ताली बजाने वाले चाहिए या ताली बजवाने वाले चाहिए? That depends upon you, how you are prepared yourself. Let us take today's insight forward in our organization, our profession, and our own thinking. And that is, thinking is most important, that we have to take care. Because valuation is not about predicting tomorrow, it is about creating it. So when you have to create something, then the creation will come when you have a complete figure, complete number, complete vision, and complete clarity on thought that how you want to move. So thank you, all our speakers, participants, and the panelists and the CP team who has worked hard for making this and making this 244 webinar continuously. We look forward to seeing you again in our next webinar, which I have already informed you on 12th December. We are having the competition tech key issues, challenges in the way forward. And we are specifically focusing on digitalize competition process where antitrust is also there and the government is coming out with the law also. We will discuss that. And Mr. G.R. Bhatia will be our star speaker on this. Till then, good night and take care.
Thank you, sir.